Reconvene the Investment Committee meeting. We will start on item CalPERS Trust Level Review Staff's Report.
Great, terrific, Mr. Chair, thank you. So during the break, we always try and highlight things that you haven't spent a lot of time during the consultant hour, so we've divvied up the pages of the presentation. I think we can make up some time because I know we have a busy afternoon as well. First, we're going to hear from John Rothfield, our CalPERS economist, to highlight the main pieces in his report. And then following that, we're going to pick and choose from the rest of the staff presentation. We're going to cover one page on performance attribution, a couple pages on the volatility section Eric will cover, and then lastly, just a very brief report on our GIPS compliance, because we think that's a very important milestone to underscore. Okay, so that's the play to come, and with that, John, you're going to kick us off.
Thank you. Good afternoon, everybody. I wanted to, I know that we've already prosecuted quite a bit of the material about the relationship between the economy and asset prices or financial markets already in the morning session today, but I wanted to take you through the familiar table that we do for every one of these presentations, which is on page 2 of the macro report. And I wanted to curate it a little bit differently today because I usually put in the positive and the negative trends in the economy. But I wanted to kind of make a contrast between the positive trends in the economy, which are a little bit backward-looking, and some of the potential negatives, which are more forward-looking. So unlike some of the exuberance that's been in the market and estimates going up for economic growth in the next couple of years, I'm a little bit more cautious about the outlook for the economy over the next couple of years. And so looking at things that are positive in the economy, again, a lot of these are backward-looking. So the economy is growing roughly at its potential rate. Estimates of potential growth in the economy vary between the mid-1s and the mid-2s, if you like, probably centered around 2%, and also flat leverage. So leverage in the economy, which is the combination of government borrowing, household and non-financial corporate borrowing, is at the same now as it was at the start of the expansion. It's about 2.5 times 1 year's GDP. So last year we actually growth accelerated a little bit to 2.5%. That's a little above the average of the first 7.5 years of the expansion. As Wilshire mentioned this morning, we've had a significant tick up in CapEx intentions and hiring intentions by the corporate sector. To date, a little bit of that, but not much of it has been realized. We're also coming into to the end of the year in a very high corporate earnings and sales environment. So whether you take all of earnings and sales or you take out volatile sectors like banks and energy sectors, the economy toward the end of the year, particularly for corporates, was doing very well. You had an improvement in mining investment last year as energy prices improved. And in the manufacturing sector, you didn't actually have an increase in plant investment in the US with some of these industries supposedly coming back onshore. But you did have a significant increase in use of existing capacity so far of the manufacturers that are out there. And then probably an unheralded part of the improvement in the global economy, which the administration can't really take credit for, is we've had such a strong upswing in the global economy since the spring of 2016. So that's about 18 months old. The falling dollar has allowed China to isolate its economy from the rest of the world. The Olympics coming up in Tokyo, combined with the stabilization of the housing market, has improved Japan's economy. And Europe's economy, after many years of downturn, has improved to the point where corporates are actually complaining that they can't find enough labor in Europe to fund their future expansion. And the US, particularly with the dollar falling, has been able to leverage off this improvement in the global economy, which is quite sustained now, and that's led to some improvement in the US economy. A final factor that I wanted to mention that I had initially in the same trend is a significant improvement in the US housing market. So that's one area that I don't worry that much about because toward the end of last year, really for about a year now, you've had a movement back toward household formation. So that's people instead of and not only has household formation increased, people going into new homes from larger households, if you like, but more of that has happened for ownership rather than rental, and a lot more of that has happened for younger people and lower income people. So in the last year or so, as you get toward the point where the wealthier and older people have kind of got into their houses, you're getting to the point now where lower income and younger people are starting to form houses in which they're going for ownership rather than just rental. So that's a good thing. And also, there continues to be an underbuild of houses, so the number of vacant houses around the country for either rental or sale is still quite low, and it would suggest that if the expansion continues, you've got some more upside in construction of housing, both single family and even to some degree multi. Then when you start thinking about the future, what I worry about is we're eight and a half years into an economic expansion, and we're having an unprecedented stimulus to the economy coming out of tax cuts, spending increases, even before the infrastructure program was announced today. And so that gets you into a high-pressure economy toward the end of a business cycle where the labour market is very tight, and central banks around the world are unwinding their support for the markets, adding less liquidity provision going forward. And so what you end up with is a higher risk, potentially low reward situation in the economy. Now, a lot of economists have said that because of all of this stimulus, the economy can grow potentially as high as 3% this year. I'm a little sceptical about that. I think that because of the demographics that are continuing to work on the economy, probably the potential growth rate is still fairly close to 2%. So what you're going to get with this big stimulus is what they call crowding out. So interest rates have to go up. You'll probably get some more inflation, which will erode the purchasing power of the tax cuts that are being given. And also you'll probably get a widening of the trade deficit. You can't save less and spend more through investment without having to borrow more from the rest of the world. That's almost an economic identity. So I worry about those particular things. And then some of the specifics of that, tight labour markets, there are not many healthy, skilled and short-term unemployed left in the economy right now. At the same time that we're contemplating cutting back on things like lottery visa for skilled workers. The savings rate in the economy has fallen below 3%, it's down to 2.4%. Which is as low as it got at the end of the last economic cycle. And then, as I mentioned, you're starting to get monetary accommodation unwind, not only by the Fed, which is starting to roll off its balance sheet purchases, but you're starting to see that with the European Central Bank and the Bank of Japan as well. And so, again, these are the things that I worry about. And if you go to page 7 of the presentation, I think in stylized facts, you can see that in the first year, what the chart there does is it basically says on the right-hand side what's happened to markets. So the S&P 500, this is just in the year to December, so it doesn't include the movements in the markets in January. You can see that the S&P 500 has grown much more quickly than it did in the first 7.5 years of the expansion. Consumer confidence and also business confidence have also commensurately grown very quickly because of this improvement in financial variables, particularly the stock market. But on the left-hand side, you can see that the economy hasn't so far deserved the improvement in the markets. GDP growth rose by 2.5% versus the expansion average of 2.2%. A lot of that is due to this very volatile mining sector. Jobs growth is about the same, labour force growth and the unemployment rate fall have pretty much been the same. So what the financial markets seem to be doing is bringing forward or paying forward, if you like, the expected improvement in the economy in the next 12 months. And it relies on a lot of things happening. Higher productivity, increased labour force participation, international funding of our larger deficits, etc., without ultimately being disappointed. And then going to page 8, what we've done in there is we've assumed that the amount of combined purchases by the three main central banks, the European Central Bank, the Bank of Japan and the Fed, which was around $2.2 trillion in 2017, is coming down to about $700 billion, so about a two-thirds reduction in net purchases by central banks, which is essentially the liquidity provision over the last few years that's held down volatility in the markets. And what you worry about on the right-hand side of that is that, yes, we are giving tax cuts and wage increases, but a lot of that's going to be dissipated by the impact of higher interest rates on what they call household financial obligations ratio, the cost of servicing debt, other payments that consumers have to make because the debt market is struggling relative to the stock market. So finishing up on page 9, what I tried to show there is that put a little bit more in the downside risk on the economy. So valuation and policy risk, the risk of a policy mistake, the fact that valuations are high and are expecting the economy to deliver a lot in the next couple of years, which may not happen. So I wanted to put a little bit more in that downside bucket in terms of stylized scenarios for the economy. And you know, a lot of economists are saying this expansion's got about 2.5 years left. If you start drawing on some of the things like the labour market, etc. But it is possible, because we've done such a large stimulus at this stage of the business cycle, it could, if anything, kind of accelerate the end of the business cycle.
Okay, we have a couple of questions. Ms. Taylor?
Yes, thank you. It was a great presentation. You mentioned two things that I wanted to just ask about and touch on. You said lower income people and younger people are forming their own households, with ownership being the majority of that. And I didn't see in here where you got that, so I was just a little curious
Yes,
about
I'm
that.
sorry, the data actually came out, it's kind
Afterwards?
of Murphy's Law, it came out a day after this presentation went to the
Of
printer.
course.
Yeah. I can get you that information.
That'd be great.
Okay.
Yeah, thank you. And then my second question, and I've talked to Mr. Iliopoulos about this a couple of times. You mentioned that the risk of corporate expansion in this country with the immigration restrictions coming up could impact that in expansion. Could you go into that a little bit?
Yeah, well, I think there's a couple of elements of that. Number one is, if you look at the performance of the corporate sector last year, the wage share of gross product is very low, profits are very high, there isn't much labour around, so why haven't these labour-saving productive investments already started to occur before we got into this kind of high-pressure system where borrowing costs actually for corporates may go up? So. And then another problem is, where does the labour come from? If we're going to be bringing jobs, you can make the case that some of the winning states in this are going to be some of the red states in the Midwest and the South, which still have a relatively high unemployment rate. But a lot of the data on the remaining workers in those states suggests that there's not much of a skill issue there. It takes a long time to create the kind of skills to make productive investments that are going to be evident. So ultimately, equity strategists say that the main effect, the main impulse for corporate investment is ultimately expected future sales. It's not tax breaks. We've had accelerated depreciation before that hasn't had much meaningful impact on the investment rate. So there is some skepticism about whether this transfer from the debt to the corporate equity market, if you like, is actually going to spur on a lot of investment. And again, I think that skilled migration, how do you find the skilled workers that can engage in this kind of activity, is going to be one of the issues.
Do you consider that a risk?
Yes, I do. Yeah.
Okay. All right. Thank you.
Mrs. Mather?
Thank you. Yeah. Have you looked at all, sort of at the macro level, at what the cost of some of these extreme weather events, be them floods or fires in California, or a combination of flooding and fires in California and beyond? Around, I mean, it's not just limited to California. Have you done an assessment of what that toll is, and any sense of that?
Haven't unfortunately done that. There's a lot of East Coast bias in Wall Street economics, and a lot of the analysis of the impact on gross product is on the snowfall on the East Coast, and the impact of all these events that we've had in California hasn't really been worked out. I can dig out and try and see if we can find some information on that, the impact on this particular economy here. Usually these events are expected to be something that pulls back growth, but there's a positive growth impact going forward. But at some point, maybe the fact that, you know, in this with climate change and things like that, there may be a permanent constraint on growth coming from the increased incidence of this kind of weather event.
Yeah, I'd be interested, as you know, not urgently, but I think it'd be interesting to have a better sense of what the implications are for that, both from an economic standpoint, but sort of ongoing growth constraint.
Okay.
Yeah, thank you.
Okay, Mr. Miller.
Yeah, we talked a little bit earlier about the implications of this infrastructure stimulus that the president has announced. And of course, the devil seems to be in the details. And some of the initial thoughts on it seem to be that while it's a very large nominal figure that one would think would have a real impact, that it sounds like maybe some of the restrictions in terms of the administration's requirements for state and private funding to a much greater extent than has typically been the case. You know, historically, the feds would maybe kick in 80–90%, and it sounds like it's almost going to flip that on its head, that it could actually kind of be a negative when we've got a lot of states. I think we've got like 18 states or more, many of them red states, that have had to increase gas taxes and things like that to try to deal with their own infrastructure needs, that they simply aren't going to have the money to do more than a match, let alone a match for the federal. So any thoughts on, you know, how do we suss out the details and how they'll impact the bigger picture, or will they?
I really agree with the comment that you made, which is that, you know, there's been such a build-up in prospective federal debt that the situation here seems to be to pass some of this on to state and local kind of municipal level debt funding or raising revenue, which goes to the whole issue about you can't really add to growth without these, you know, what they call crowding out. And crowding out means, you know, increasing things like gas charges or something like that to try and offset the cost, because none of this stuff comes for free. And so, you know, when you look at state and local jurisdictions, they're fiscally, there is a lot of question marks about whether they can afford to participate in this without raising a whole bunch of charges, which brings, again, some problems back to you getting on the one hand and you're giving back on the other. So I would agree with that.
Yeah, thank you, John. I always enjoy your comments. My question goes to, during the last financial crisis, the Fed had a number of things in their toolbox to ward off the complete disaster. And on your chart, you talk about some of the downsides. And so we see that the Open Market Committee may raise rates 3 or 4 times this coming year, but it's still not going to be high enough to utilize to deal with a crisis again. The quantitative easing balance sheet is still very large. So what other things are in the federal government's toolbox to ward off a or deal with another financial crisis, because you got low interest rates, you got these large balance sheet balances, and so what else is there they can do if to ward off another financial crisis?
Right. Well, in theory, they can cut rates back towards zero to a quarter, where they started the whole process at the end of 2015. They can stop and then maybe even reverse some of the balance sheet reduction that they've done. I mean, in theory, they can do that, but a lot of people are worried about the asymmetry of it, right? So it's hard to put that back on. Another route that they're going down is to reduce regulation of the banking sector, to allow small banks to lend to small businesses, etc., in a more effective way than they have been up until now. Take away some of the burdensome regulation. But to be honest, when you look at what's restraining small business, it's not lack of access to credit, it's lack of access to appropriate labour. Just haven't been able to find labour. They've had the access to credit. So it is very difficult to think, and it would be nice to be able to go through a couple of years of growth where the Fed can fully normalise policy so that they have some runway when the economy goes into the next downturn. But we're not there right now, which does add an element of concern.
Okay, thank you. Okay, no further questions on that. Thank you again.
Great. We're going to switch to the next packet of information. Stick you there. I'm going to turn to Michael Krim, who's going to start with a discussion on performance attribution for the total fund. There's attachment 2, I believe.
It's attachment 2.
You need to get to attachment 2. While we're waiting for that, Ms. Mather, it's interesting. We must be thinking alike. I had just actually looked up some information from the National Atmospheric and Oceanographic Organization, NAO, on that very topic, and actually, and we hadn't we hadn't corresponded at all on this, but I almost included it in my CIO points earlier in terms of things to look forward. But in the United States, according to their information, since 1980, we've had 218 weather and climate disasters since 1980. With a cost exceeding $1.2 trillion. And that does not include, as John was mentioning, does not include this year's hurricane or fire-related data. So I'll make sure to get that information. What it doesn't say is the question you asked, which is, how, what effects on growth does it have, and what effects do the future forecasts of higher and higher, more frequent and higher magnitude events have, and that's certainly something we have been working on modeling. And hey, I used the time.
Thanks,
There
Ted.
you go.
Hi, I'm Michael Krim. I am Director of Risk and Performance in the Investment Office. We started publishing our attribution of total plan excess returns about 1.5 years ago. And since this is still a relatively new topic that we're covering, we wanted to continue to spend a little time on it in each of these meetings. Now, Wilshire showed you their attribution earlier this morning, and the numbers are essentially the same. They're obviously coming from the same source. We always compare them side by side to make sure we understand the differences. They're usually technical in nature. There is one difference in how we organize and present the results that I think I do want to highlight, so I'm going to walk you through our attribution as well today. As a reminder, performance attribution is an analysis that decomposes the plan's excess return into its constituent drivers. So the focus is on excess return, not the total performance of the plan. And all the numbers on this page are excess. That means the performance of the portfolio relative to the benchmark. And since presenting this view is still somewhat new, I'm going to spend a little time and go through the table in detail. And just to orient everyone, I'm going to be talking about the one-year numbers, which is the same period that Wilshire covered. And I'm going to start you on the very top in the gray bar, 25. That's the total excess return for the year. So that is the number that this attribution is seeking to explain. And the blue bars are the various higher level drivers that together make up that 25 basis points. The first two sections on the table are from the public and private program contributions. And this is simply the impact of each individual program's performance on the total plan excess return. So it's the impact of the respective excess returns of those programs when measured at the level of the total plan. And the story you see here, and again, Wilshire covered this as well, you can see for the public programs, we netted out flat for the year with a negative 15 basis points from global equity offset by fixed income and a little bit from the other programs. For the private programs, we had minus 36 basis points coming from private equity relative to its benchmark and positive 24 from real assets. But for this period, the bulk of the plan's excess return came from the next two drivers, which we call allocation management and public proxy performance, and I'll explain that last one in a minute. Together, these each contributed 14 basis points and 22 basis points, respectively. So I hope you're following them down the column, the one-year column there on the table. The allocation management refers to the activity of managing the relative weights to each of our public programs compared to the interim policy target weights in effect throughout the year. For this past year, most of the 14 basis points allocation management return is explained by having been slightly overweight public equities, which outperformed all other asset classes. So that is not shown on the table, but that's what drove that 14 basis points. The last driver, public proxies, bears a brief explanation. Recall that in our policy benchmark, we specify a fixed allocation weight to our private assets. For example, for real estate, our interim strategic allocation weight has been 11% of the plan for the past year. However, we cannot simply choose to go out and deploy an exact portion of the plan to a private asset class in the same way we could for public markets. These asset classes are illiquid and costly to transact in, and we're often constrained by the availability of investment opportunities meeting our underwriting criteria. As a result, there will inevitably be differences between our held weight in private assets at any point in time versus the precise weight specified by policy. And for the past year, we were roughly, just to continue the conversation about real estate, we were roughly 2% underweight our target allocation to real estate. When a gap like this occurs, we naturally use what we have, which is our public assets, to plug the gap. That is what we label here as proxying. Note that proxying, as we use the term, doesn't have to refer to the outcome of a formal proxy strategy for private assets. It's simply the other side of the coin of being underinvested in any given private asset class. And since for this past year, that 22 basis points is basically explained by the fact that having been underweight real assets, we held commensurately more in the other assets, particularly in public equities, which did better than the real assets real estate benchmark this year. And so that is what explains that 22 basis points of outperformance. So, and again, on that last driver, I just want to emphasize that, and the reason we pull this out in this way, that this proxying attribution driver, it's really an artifact of our benchmarking methodology and its use of fixed weights in the private asset classes. It is not that we're making an explicit investment decision to hold less real estate because, for example, we think that public equities would have outperformed this year. Rather, it kind of falls out of the investment process for those private assets. And that really is the primary distinction if you're going to squint at, if you wanted to look at the Wilshire attribution table, they group both this allocation management and public proxy together under the term allocation. All we've done is separated those out. So that's what I wanted to talk about in terms of the attribution. And now I think Eric was going to share some of our thoughts on the risk environment.
Okay, before you go
If you have
to
questions.
the next, Ms. Mather?
Thank you so much for your explanation of this chart. I just want to understand on the public proxy, let's say we're underweight a private asset class, then that under allocation gets reallocated pro rata among the remaining asset classes, or is there some decision about what is the best proxy in the public markets for this asset class? So, for example, if it's private equity, would we only use the equity markets, or would we also use fixed income?
So for this purpose, in general, for equities, for private equity, we would use global equity. For real assets, we're using an equal weighted mix of the plan. But really, that's a decision that's made as part of the monthly strategic dynamic allocation process.
Okay, so there's no policy
There's no
governing
policy.
that. It is really
It's a
the
s-
sort of
it's a
best
staff decision.
judgment of the team.
Yeah.
Okay. And it's not some subset, it wouldn't be some subset of the public equities, for example. It wouldn't be some subset that we think best matches, small cap or something that best matches.
No,
private equity.
that's not what it has been. Yeah.
Okay, thank you.
Okay, next.
Okay, good afternoon. Eric Baggeson, CalPERS investment staff. Just following on some of the comments that Ted made in relation to volatility and some of the discussion that happened during the Wilshire item today, we just wanted to just catch up on a couple of elements of this. I guess the first thing to recognize is that there's lots of different volatility measures that roll around this organization and the reporting that we have. So, for example, the chart that we have on page 12 of attachment 2, this is basically a trailing 12-month volatility going back pretty significantly in time. So you have a lot of years of observations. And again, this is a trailing 12-month volatility. So you see as of December 31st of 2017, that number actually represented 6.7%. If you look at the reporting that we have in the both in the consent reporting and some of the other reports attached to agenda item 6, you'll see that the calculated volatility coming from the borrower risk system for the CalPERS portfolio is 7.4%. So that's a volatility that is calculated based on actually an average of 2 to 3 years of volatility numbers. Then if you think of the next page of this representation, or the next piece of material, what you see is we have 2 more volatility numbers. So we have the 7.4%. This is basically coming out of the borrower risk platform. And then we've got the 11.5% basically that came out of the ALM exercise. So this whole discussion of volatility can actually be quite confusing. And what we use for the ALM exercise is we're using a much longer run volatility. These are calculated over approximately a 20-year period. So you can literally see how that volatility regime has changed over time. And it becomes pretty important to understand exactly what frame of reference that you're speaking about when you start looking at any one of these measures. And there is no one number that is more right or wrong than any other number. It all depends on what the purpose is. So we use a longer term volatility given that we're basically establishing a set of expectations for a 10-year period into the future, in contrast to the more contemporaneous measurements that, for example, are coming out of the borrower risk system, or if you look at that chart showing a trailing 12-month volatility. We would not want to, in essence, plan on a low volatility environment, and then you walk into the kinds of events that we had over the last 2 weeks, and suddenly that whole volatility regime could shift. So in essence, we believe that our ALM type numbers provide us with an approximation of what we consider a sort of quote unquote normal volatility environment, which we think is more relevant for something like the long-term ALM planning. One of the other things that we wanted to do was to point out also, as we go through exercises like the ALM work and setting of expectations and doing calculations, optimizations, all of this sort of mathematical derivation of the conditions that affect the investment program. What we wanted to highlight with the chart on page 14 is the fact that when we establish, for example, our assumed rate of return of being 6% or 7% or 7.5%, that in essence is a central tendency of a distribution of potential outcomes. So what you've got on this page, and this is just looking at investment outcomes, this isn't looking at the cash flows of the portfolio and the things that impact the actual net asset value of the CalPERS portfolio. But if you just look around a central tendency, and this is built on just looking at a 6% return number, you can see, for example, the range of possible total values for the CalPERS portfolio with a sort of 2/3 of the time probability, that 68% probability number, could range in 5 years' time from an expectation of $340 billion of value, which is a little bit less than we're currently at, to a high of $570-odd billion. So you start to see the breadth of potential outcomes that can happen. So we tend to think about these numbers and perhaps attach too much specificity to a specific measurement or a specific rate of return. There's been a lot of discussion, for example, about the shorter term, 1 to 10 year set of return expectations, which ranges around 6.1 or 6.2%, relative to the longer term numbers that range out to 7 or 7.5%. Our expectation from the investment office is that all of this information is so nonspecific that we would not interpret the expectation being rational of a 6% return number for the next 10 years and then suddenly jumping up 130 or 40 basis points from that for the following years after that time period. We truthfully have no idea when the returns are going to be generated or the losses be generated in this distribution of potential outcomes. So we caution you to not overinterpret the specificity of some of the data that gets put in front of you. What is important, though, is actually understanding the potential of downside risk. And for the board members that have been on the board for some time, we went through a whole exercise over the last year and a half, basically digging into some of the portfolio priorities, and we identified downside risk as a priority to try to de-emphasize the downside risk to the extent that that's possible to do. But what you see is that if right now, and this is based on our current portfolio structure, not the new ALM exercise or the new asset allocation that we'll be moving towards, but based on our current portfolio, you see if we replayed the financial crisis, for example, you would be looking at a potential 36% drawdown in that kind of an environment, where the value of the portfolio would decline by almost $130 billion, and you would then have a commensurate, if this happened in one time period, shock to the funded ratio, you would be dropping into the mid-40s to low 40% range on the funded ratio. This risk is real, and this is the kind of risk that engenders from the equity portfolio that drives the majority of the risk in this portfolio. The Wilshire data today pointed out that about 85% of the risk in this portfolio emanates from the public equity space and the equity and growth-related investments that we have. So it's also private equity attached to that. But it's just important that you as a board understand just how variable the potential outcomes can be in any specific time period. And we have absolutely no mechanism to forecast when these kinds of events could potentially hit this portfolio. So we invest into this risk with a long-term expectation that that is the way to keep the cost of funding the benefits that have been promised as inexpensive as possible. But that's the other side of that coin, is the risk that's being taken in an effort to try to pursue a relatively high rate of return. So that's basically the message that we wanted to emphasize at this point in time in the discussion. And I think at this point, we can turn it over to Rob to talk about GIPS standards, or if you have any questions, be happy to answer.
No, next.
Great.
Good afternoon. Rob Patterson, CalPERS, Investment Risk and Performance. And I'm pleased to announce that we are now able to make the claim of compliance with the Global Investment Performance Standards, commonly referred to as GIPS. And this work is a culmination of a multi-year effort, including support from the Investment Office, FINO, as well as ECOM. And I felt I would first start by describing why it is important that we're adopting these standards, and then provide some additional details on the claim of compliance. So a little bit of background. The GIPS standards are a set of principles that define how performance is measured and reported. They're sponsored by the CFA Institute and are widely adopted by asset managers. As a means of comparison, I would liken the standards to GASB from an accounting perspective. And the standards are based off of two core ethical principles: full disclosure and fair representation, which are intended to increase the level of trust and confidence people have in the investment performance information that we present. As part of making the claim of compliance, we completed an independent verification and examination of our performance measurement and reporting processes, and that was conducted by the Spalding Group. The verification is somewhat analogous to an accounting audit, where you go through and you review processes and controls to make sure that they're compliant with the standards. And the verification is a bit more detailed, where the actual performance of the fund, as well as the benchmark and any disclosures that we include in the compliant presentation, are vetted for accuracy and compliance with the standards. So as part of making the claim of compliance, we will begin providing to you, as we did in this instance in your attachments, what are referred to as a compliant presentation. And from this point moving forward, we'll begin doing so on an annual basis. So continuing to leverage that accounting analogy, the compliant presentation that I mentioned is comparable to a formal financial statement. For example, the CAFR, or the Comprehensive Annual Financial Report. The compliant presentation provides things like a standardized view of performance, important disclosures that define how it is we value things in the portfolio and how we calculate performance, and also details on asset allocation and the benchmark composition. So moving on to the next slide, there's a number of benefits resulting from adopting the standards. And I would generally describe them as lending to improved credibility and comparability. Let me explain what I mean by that. As part of adopting the standards, which are a set of industry best practices, we conducted a thorough review of our documentation to make sure that they were compliant with the standards. All of that work then was reviewed by an independent verifier and examination process to make sure that it was all compliant with those standards, lending to increased credibility and consistency of what it is we produce. And then second, once we're able to produce that information, the hope is that we're going to have other pension plans follow on and begin adopting the standards similar to us so that we can then have increased comparability of our performance results relative to other plans. So I'll conclude by just sharing a little bit about what changed. And what I'd say is, by and large, all of our processes and performance methodology and valuation approaches and things of that sort were consistent with the standards. There were two primary things that needed to change. One is that we had to move the frequency of valuing, or the valuation of real assets, from an annual basis to a quarterly basis, and that became effective fiscal year 15-16, or July 1st, 2015. Second, we began to include internal expenses in the performance that we report, and that started at the same point in time. So I'd like to conclude by sharing that I think one of the reasons this is what I consider a big deal is that we are one of the first pension plans in the US and also in the world that has adopted the standards and making the claim of compliance. And I think what it does is it demonstrates really our leadership in the space and also our commitment to increased transparency. So I'll open it up for any questions.
Yeah, we do have a couple questions. Thank you, and we applaud you for taking the initiative to continue to set the pace in this industry. So good work. Mrs. Mather?
Yeah, thank you. I have a question. You note that we're now valuing real assets quarterly. I imagine there's quite a hefty price tag associated with that. Do you know how much that costs?
So the process moved from independent valuations on an annual basis, and now what we do is we receive from the managers valuations on the interim quarters. So
Okay.
no additional costs as a result
so
of that.
it's not because I was imagining doing.
Yeah.
So that answers my question. Thank you.
Okay. Ms. Brown?
My question was related to cost, so thank you very much.
Okay. Yeah. Ms. Taylor?
Yeah, thank you. I was just curious as to what the value of doing this quarterly is supposed to do. I know it's part of changing the way we're doing this under the GIPS, but what's the value of that? Because we're a long-term fund, so I'm a little confused at the value.
Yeah, you want to take that one?
Michael Krim, CalPERS staff. So the The difference in performance numbers, by and large, is not going to change. But when it matters is when there's a large movement in the asset values. And in that case, this forces the performance to keep up with essentially market conditions. That's the primary reason that they have it as part of the standards.
Okay, so for example, then during the 2008 crash, and it said real assets. So our real assets, our real estate portfolio went down quite a bit. So that's what this is supposed to measure as it happens? Is that what you're saying? Basically, almost as it happens?
That's essentially the logic. In the performance community, the basic thinking is that the more timely, the better. And the GIPS Standards Committee, this is part of the CFA Institute, shows quarterly as a compromise between the timeliness that one should be able to expect from a modern kind of private asset class investment, and the considerations that it does require, a valuation or assessment of some kind.
Okay, I'm not sure that answered my question. And then the second part was including our internal expenses and performance 4 basis points. So that's not a big deal, and it doesn't cost us a lot to do that, I imagine. But the value of the real assets quarterly, I'm not quite clear on how that's really making a difference. And I know it's part of this process that we've joined and become a leader in, but I'm not quite clear on how that's helpful.
I'll just jump in just quickly. So thinking about the financial crisis time period, we were very focused on the real estate portfolio at that time, and our valuation data was very stale, over a year, and we actually implemented an interim valuation just to catch up, to understand where values were falling, what at different markets, different impacts, different sub-asset classes. So it's important to have more timely assessments of the value of your portfolio. We're making commitments all the time across the real estate portfolio to buy or sell more or less office, buy or sell more or less apartments, and the staler your evaluation information is, the less precise you can be in constructing your portfolio.
And so on a quarterly basis, as we move forward and something like 2008 starts to happen, we start to see the value go down, and we're able to move that more quickly, is what you're saying.
We just have more confidence in what our values are
Or
in order
get
to
out
make
of it
decisions.
more quickly. Okay. And is this just for real assets or overall?
Yeah, so what we're making a claim of compliance is with our 7 specific funds. And so a little bit of background there is the CFA Institute defines a firm. It's kind of one of the underlying tenets. And the idea is the firm is how you extend yourself to your market, or to whom it is that you are reporting performance, ultimately who it is that's going to act on that information. And so what we're making the claim of compliance with is that of the asset owner, which is the 7 compliant presentations you have in the attachment, one of those being the PERF. We're not producing any information below the top level figure at this point in time. That could be a second effort that we can pursue, but it's at the top level. The remaining, which is not yet in scope, would be an additional firm that we'd look to make the claim of compliance of at some point in the future. There's slightly different requirements around the additional funds. It would be the CERP 1, 2, and 3, and the target date funds, which we will do 3-4 years, or evaluate doing that 3-4 years into the future.
Okay. Thank you.
Okay, thank you. Does that conclude the presentation, Mr. Aliopoulos?
It sure
Okay,
does.
we do have a request to speak on this item, Mr. Wiley Tarlett. And you know the rules.
I do know the rules, actually. I think you need the 3 up there, right? I wouldn't want to use more
3?
time than
Yeah,
I'm
okay,
allocated.
yeah. All right.
Thank you. Investment Committee, President Mather, and congratulations, Chairman Jones and Vice Chairman Costigan. I was giving my team a hard time back in December about actually using my 3 minutes, and so I'm here to make good on that threat. And it's great to see everyone, all my friends and colleagues. I'd like to commend and support CalPERS and the investment staff for moving to GIPS compliance. There's currently a very large disparity in performance reporting amongst the public plans in the U.S. Last year, the Pew Charitable Trust provided a report that indicated roughly half of the states report some combination of gross and net performance. There's 10 states that actually report gross performance only. And so it's very important to understand your performance returns because it's what you use to make future investment decisions and to make better investment decisions. And expenses, as we all know, thanks to good old investment belief number 8, matter. And so the incorporation of accurate expenses, including internal investment office expenses, current valuations, and all of the other pieces of information that go into reporting, according to GIPS, make a huge difference in the quality of the performance reporting landscape. And for CalPERS to take this step, I think only Ohio Teachers is the only other public plan that actually reports according to GIPS, and I'm hopeful that we see many other plans take this additional step. So thank you to the investment staff, and good to see you all.
Okay, thank you, Ali. Yeah, thank you. Okay, so that concludes the discussion on that item. We will now move to revision of real assets program policy, first reading.
Good afternoon, Matt Flynn, CalPERS team member. I'm joined momentarily by Kit Crocker from our Investment Compliance and Operational Risk team. Kit's going to walk you through the first read of this revision to the real assets investment policy. Take it away, Kit.
Good afternoon, Kit Crocker, CalPERS staff. With staff support, this committee will recall that it completed a substantial revamp of essentially all our investment policies in 2016. Staff reviews each individual program policy on a roughly annual basis for any indicated updates. And item 7A is a first reading of staff's proposed updates to the Real Assets Program's investment policy. The last round of revisions was in late 2016 and coincided with the new strategic plan. In staff's view, these latest revisions are largely cleanup in nature, with a possible exception of some items noted in the agenda item memo. So the committee has received clean and markup versions of the policy, along with opinion letters from PCA, Makita, and Wilshire as the board's investment policy consultants. And at this point, this is an information item. We're looking for feedback. And with that, I'll pause for any questions and also invite PCA, Makita, and Wilshire to make any comments they may have.
Okay. I see no questions from committee members. Wilshire, Makita, and no comments. So this will come back as a second reading next month. Okay, thank you for the report. Okay, that concludes our agenda items. So summary of committee direction, Mr. Eliopoulos.
I think I'll go in reverse order. So I think the economic impact of weather-related events gave a brief verbal response. It'll take us some more work into the future to think through the economic piece, but John will work to do that. That sounds okay. I think we committed to do that.
Yes.
There was a request, and I'm not sure whether or not it was directed to provide some data on the low income and cohort and youth cohort for increased housing data on household formation.
Yes, that's the direction.
Okay.
Yeah, that's Ms. Taylor's request.
Yes, we'll provide that.
Okay.
And then lastly, I think you tabled the discussion for March whether or not to have a separate agenda item to consider.
Yes, I'm going to consider that.
Pardon me?
I'm going to consider that.
You can still consider that. Okay, that was the last one that we had.
Okay, thank you. Okay, well, that ends this meeting. We'll join and we will go into closed session in 10 minutes. Thank you very much for a wonderful
Do you want to,
presentation.
did you want to announce that risk and audit?
Oh,
We don't know until after closed
closed
Yeah, no,
session.
but no one's here. 4 o'clock.
You estimated, okay. You want to,
Estimated was 2 o'clock. Anyway, all right.
you want to estimate it, risk and audit?
Well, no, yeah, I don't know how long you're closed.
Well, it always depends on the questions.